ETF Edge, where are people looking to hide out within the ETF spectrum, Bob?
Oh, I have somebody who knows the answer to that, Scott. The wild markets are placing new emphasis on ETFs that are tactical in nature. That is, those that are not tied to indexes and can quickly allocate and reallocate resources. Let's talk to one of those managers. Katie Stockton, an old friend of ours, founder and managing partner of Fairlead Strategies, also manages the Fairlead Tactical ETF. And before I ask you about your ETF, you're a longtime active manager. What are you doing now, and what are you advising your clients?
We believe that the loss of momentum behind the S&P 500 will stay with it for most of this year, if not even into next year. And therein, we've been recommending our clients manage risk. And that means different things for different people, but it can be more defensive leaning in your sector positioning for one, more asset classes that have a lower correlation to the S&P 500. We are seeing this as a cyclical down move within a secular bull trend, so we'll be excited to come out the other side of it.
Now, I want to talk about your ETF, your tactical ETF, TACK, T-A-C-K. You just passed the 3-year mark. That's important for managers. Congratulations.
Thank you.
So you rotate on this between the 11 S&P 500 sectors. We all know that, but you rotate between that and gold, long and short-term treasuries. It rebalances every month. Here's a summary. Where are you invested now? What are you doing with this right now?
Well, we have 8 equal-weighted buckets that we try to fill with the best sectors. So we're eliminating the bottom 3 based on our technical metrics. And these are long-term indicators that we're using to eliminate noise, only identifying long-term shifts. So we want to be in those sectors that have the best long-term momentum, the best relative performance. And if 8 sectors aren't qualifying, we will give that bucket to other asset classes. And that's where we stand currently. We have 7 sectors that are qualifying. We recently eliminated the technology sector, which is very significant, of course. And we have small pieces in short-term treasuries, long-term treasuries, and gold.
So this is fairly defensive. So consumer staples, utilities, no holdings in tech at all. You don't own the tech sector. You've got a small weight in gold. You've got small weight in long and long-term bonds. It's still almost 90%, 88% stocks, though, right? And here's a little list here. Is that going to change at all? You do this every month, right?
It will continue to change. It's model-driven, so 100% systematic based on our technical models. We held technology from 2023 to all the way through until last month, really. So we did ride that technology outperformance, but with an equal weight position, we also morphed into these other sectors that had the opportunity to emerge, as they have done this year, as outperformers. So that heavy defensive sector exposure is something we expect to stick with here for a while, whereas we expect the higher beta sectors of the market to gradually be removed from the TACK ETF and be replaced with those alternative asset classes.
So this strategy you're using, run here, would underperform if tech was dominant, which is what's been happening until a couple months ago, and would outperform if the market was dropping and bonds were rallying. That's been partly true recently. I guess this is a long-term way of saying it's been tough being a tactical manager, hasn't it, in the last few years?
So the benchmark for the TACK ETF is actually the Russell 1000 Equal Weight Index, and the secondary benchmark is something close to a 60-40 comparison. So TACK's design is to be a holistic portfolio. And you're right, if the tech sector is the primary or sole source of upside leadership, 2023 was a great example. It will underperform the S&P 500, but it can outperform its benchmarks. We recommend holding TACK as a holding that hopefully won't let you down, it should let you sleep at night, and then supplementing that with technology stocks.
We got to let you go, but bonds underperforming here, bonds down is a major problem for this portfolio and for a lot of people that are out there. Is that a little bit of a surprise to you?
For the TACK portfolio, which has also that piece in gold and the short-term treasuries, which is close to our cash equivalent, it does actually fairly well with that diversification on the risk-off front.
Okay. Going to have to leave you go. Always a pleasure to see you. We're going to have a lot more on tactical trading of stocks, bonds, and gold. That's coming up on ETF Edge, 1:10 p.m. Eastern Time. Katie's going to be joined by Troy Donahue. He's the head of America's portfolio trading at BTIG. Is ETFEdge.cnbc.com. Scott, back to you.